So this is part number 48 of this multi-part video series for positional stock traders. In this video, I want to talk about the characteristics of a flat base. It's a very simple base to identify. I think I have done one video on flat base, but this is a far better example of a flat base. If you read William O'Neill's book, in that book, he talks about the flat base as a base that comes generally in base 2 or base 3. Why does he say that? It's because if you look at base 1 normally you have cup with handle or a cup or a saucer with handle or a double bottom. These are the four patterns that generally come as base 1. And what is the common factor in all of these four patterns? Is that they take a long time to form. They are deep patterns. So for example, if you look at this cup with handle, see there is a handle here. So if I draw this for you, it's a deep cup with handle. See, this is the IPO. This is HDFC Mutual Fund Company. So you see this cup, and that's the handle. Okay. So that's the cup with handle. That is the primary base, the first base that came into the stock after the stock got listed on the stock market. And then you have this flat base here, because after the stock broke out from here, there is not a single bar after which you have three consecutive lower bars. So this is the only bar after which you have 1, 2, 3 bars which are below the high of this bar. So this is the only bar after which the base begins. And the distance from the pivot point from here, from this pivot point till this, is easily more than 20%. So if you look at the definition of a flat base, he says that it generally comes in base number 2 or 3. So this is base 2. He also says that the correction inside the flat base is not more than 10 or 15%. So let's look at the correction. So from here till here, see the correction is 13.97%. So it is consistent with the definition given in the book by William O'Neill. So number 1, it should be base number 2 or 3. Number 2, the correction should not be more than 10 to 15%. Okay. And he also says that it normally comes when the stock goes up at least 20% or more after base 1. So after base 1, the stock has gone up 34%. So again, all the three criteria are being met. The prior uptrend from breakout from base 1 is more than 20%. Then the correction is 10 to 15%, right? And it is base number 2. The fourth part in the definition of flat base is he says that it is 5 to 6 weeks or more. So 1, 2, 3, 4, 5 weeks. Okay. So all the definition, all the criteria given in William O'Neill's book about flat base is being met here. Okay, which is what we just discussed. The 4 points. Just go to William O'Neill's book, How to Make Money in Stocks, 4th edition, go to chapter number 2, go to the section where he discusses flat base, and you will find these four factors which are a part of the definition of a flat base. Okay, and you will see that here. The problem with this base is, you see there are no tight closings and there are no tight spreads. So that adds to the risk of this base. Okay. The 4 factors which I discussed, which form the definition of a flat base, they are the ones that reduce our risk. The tight closing and tight spread, the absence of tight closing or tight spread, increase our risk. Moreover, how many red bars? 1, 2, 3. How many low volume? 2 are low volume and 1 is high volume. However, this high volume red bar has a strong closing because the closing is above the midpoint of that bar. So all the three red bars are in our favor, which means what? Which means this reduces our risk in the base. Moreover, at this time, the relative strength of the stock was 95. Now, I haven't checked the fundamentals and liquidity and uh, comparatives and things like that, but I just know that the relative strength of the stock at that time was 95, which is very high. Okay, so now you know what contributes to the risk and what does not contribute to the risk. Just because something contributes to the risk does not mean that you outright reject the stock. You weigh the risk factors. How many risk factors are in your favor? How many are not in your favor? In this case, how many are in your favor? Well, it is base number two. It comes after a 20% prior uptrend. It has five candles in the base. It has all the red bars in your favor. It is early stage base number two. The relative strength is 95. Okay, and the correction is not more than 10 to 15%. All of these factors are in your favor. What are the factors that are not in your favor? Well, maybe tight closings, tight spreads, maybe the fundamentals of the stock at that time could be weak. I don't know. I haven't checked the fundamentals. You can go and check. But I'm just showing you chart examples. I'm not going into the details of comparatives and fundamentals because those are criteria which you use to qualify stocks. So in the future, when you're buying stocks, you use that criteria to qualify stocks. But once you qualify the stocks, then ultimately you have to come to the chart, right? To take the final decision. So that's why I'm showing you charts. So this is a flat base. What's the pivot point in the flat base? That's the high of this bar. So let's draw the pivot range. So as you can see clearly, this is a nice cup with handle. After this bar, there are two red bars. So that completes the handle. Actually, it's a very deep cup. If you notice, if I draw the cup here, it's a deep cup, but the handle and the pivot point of the handle comes in the upper half of the base, which is a good sign. Okay. And that upper half concept is given in William O'Neill's book. So let's draw the pivot range. So the high of this is 2370. So let's do that. So this is 2370. Let me take out my calculator. So 2370 multiplied by 1.05, 2488, 2488, and the color will be blue. Okay, so that is the pivot range. Now let's draw the selling range. So 2370, green color, 2370 multiplied by 1.2, 2844, 2370 multiplied by 1.25, 2962. That's the selling range. Let's draw the stop loss range. 2370 multiplied by 0.92. That's 2180. And 2370 multiplied by 0.95. That's 2215. 2251. And the color will be red color. So stop loss range, buying range, and the target range or the selling range. So this is 26th of August 2019. So old chart as per the SEBI regulations, we are allowed to discuss old charts, correct? 26th August 2019. Let's go to the daily time frame chart. So this is 26th August 2019. So price blue, green, red. Price is above the 50-day, the 50 days above the 150-day, and the 150 days above the 200-day. This is the basic criteria that we look for. This is the basic Mark Minervini criteria that we look for on the daily time frame chart before taking a trade on the weekly time frame chart. Okay. So now let's look at Monday. Before we look at Monday, what do we look at? We look at volume on the previous week, which is 1.99 million. So roughly 2 million. So 2 million divided by 5. Sorry, 2 million divided by 5. So 400,000 shares should be traded on a Monday. Okay. You notice the price is between the pivot point and the blue line, 10-week simple moving average. Okay. You notice the stock after it broke out of the cup with handle, it has never closed below the 10-week simple moving average. Notice that. Okay. This was the breakout. So let's see what happens. We are expecting 400,000 on Monday. So Monday, what's the volume? 259,000. Look here. Okay. Monday, what's the volume? 259,000. Not good enough. Where is the price? Not even in the pivot range. Tuesday, see, Tuesday, the price went into the blue zone. What's the volume? 1.29 million. What were we expecting? We were expecting 800,000 because on Monday we are expecting 400,000. Tuesday we are expecting another 400,000. So that's 800,000. How much do we get by Tuesday? We get 1.29 million. And the price enters the blue zone, which means high volume, entry into the blue zone, close inside the blue zone. Everything is in our favor. We can take 50% position size. Position size means, let's say you plan to buy 10% position size. Out of 10%, you can buy 5%. Okay, so 50%, 30%, 20%. So assuming you want to buy, let's say 100 shares, so you would buy 50 shares there because the price entered the blue zone, closed inside the blue zone on high volume. Now let's look at Wednesday. Wednesday, it went up, went inside, went beyond the blue zone and came back in again. What's the expectation of volume? 400,000 multiplied by 3, right? Monday, Tuesday, Wednesday. So that's 1.2 million is what we are expecting. How much do we get? We get 2.13 million. And the price has covered the entire blue range, which means you got an opportunity to buy the remaining 30 shares and the remaining 20 shares. So by Wednesday, you are all in into the stock. So whatever position size you decided to put into the stock, you are already into the stock. Okay. So let's say 10% position size. And let's assume that you plan to sell 1/3 when the price reaches the green zone. You plan to sell another 1/3 when the price closes below the blue zone, and you sell another 1/3 when the price again closes below the blue blue line, which is the 10-week simple moving average. Okay. Let's move to Thursday, Friday. So that's the closing. Strong breakout. The breakout has happened at high volume, 3.4 million. We were expecting 2 million, right? Next, let's move it forward. Let's move the price forward because now we don't have to do anything. Now we just have to buy. So here you sell 1/3 when the price enters that green zone. You sell 1/3, you book roughly 20% gain from your average execution price to the green zone. You sell somewhere in between the blue zone. You buy somewhere in the blue zone and you sell somewhere in the green zone, correct? And roughly you can book around 20%. So somewhere here to somewhere here, that would be 20% gain. So on 1/3 of your position, you are booking how much? 20% gain. And once you sell 1/3 here, you will move your stop loss to break even. Okay. So let's say you take maybe 15% position size, assuming that in your previous 3-4 trades, you made good money. So you want to risk that gain on this stock, which you can do. So that is not taking high risk. You're risking the money that you made from the market. So let's say you take a 15% position size here. So out of 15%, you sell 5% for 20% gain, right? And then you move your stop loss to break even. So the remaining 10%, you don't lose money if the stock collapses. Okay. Let's move the price forward. Let's see what happens. Let's see when does it close below the 10-week simple moving average. Stock continues to go up. Yeah, here it closes below the 10-week simple moving average. Here it closes above the 10-week simple moving average. See, this is actually a strong closing. It is on high volume. That's actually a bounce of the low of the week. So it is actually a positive candle. Okay, we should not be selling there. But since it has closed below the blue line, we should be selling another one third there. Okay, because that is what we planned to do. So let's say from here somewhere to here, that's another 30%. So on the first one third you sell, you book 20%. Next you book 30%, right? Let's move the price forward. We wait for the price to go. We wait for the price to go beyond the 10-week simple moving average, but in this case it is not going. The moving average finally slopes down. See, as long as the moving average is sloping up, there is no problem. But if it starts to roll over, does it make sense to stay in the stock? No, right? So you might want to book all of your gains here because the moving average has started to roll over now. So there is weakness, and here you have already spent like a month, like 4 bars is like a month. So it's too much time. Makes sense to sell here. So book another 30%. So if you sell here, so let's say on the first 5%, you booked a 20% gain. On the another next 5%, you booked 30% gain. And on the next 5%, you booked roughly another 30%, right? So 5% multiplied by 20% plus 30% plus 30% is equal to 5% multiplied by, which is 30 plus 30, 60 plus 20, 80%. Right? What is 5% of 80? 5% of 80 is 4%. So this is the amount of money that you make from the stock on a portfolio level. So one stock contributes 4% to your total portfolio return. Imagine getting just 5 stocks like this in 1 year, just 5 stocks in 1 year. That's a 20% return. 4% per stock multiplied by 5. That's a 20% return in a year. So, which means as a positional trader, you don't need too many stocks in a year to generate a decent return. And if you are very selective in your stock selection process, you don't have to worry at all. So that is why I say be extremely selective, be extremely strict with your criteria. Just 3 to 5 stocks, good stocks, more than enough. And what trade management are you doing here? You are hardly doing any trade management here. You're just selling one third in the green zone. You're selling another one third when it closes below the blue line. You're selling another one third when the moving average slope turns down, which happens here on this bar. It actually turns down. So every candle has got a moving average value. So this candle has got a moving average value. This candle has got a moving average value. This candle has got a moving average value. So if you track the moving average value per bar, you will notice that on this bar, the moving average value actually turned down. So here the moving average value is 3306. Here it is 3277, right? So the moving average value has actually turned down. So that could be one reason you might want to sell, because you wouldn't want to see a downward sloping moving average, correct? You want the moving average to be continue to go up. The stock might pull back fine, but just because a stock pulls back doesn't mean that the moving average will slope down. The moving average will accommodate the pullback. Okay. Like, for example, there was a pullback here, there was a pullback here, there was a small pullback here, but the moving average continued to slope up, that's a good sign. But when the moving average itself turns down, that's a problem. So if we take the price forward, let's see what happens. Yeah, see the final collapse comes. It goes below our. So when the moving average turns down, okay, be cautious. It's better to take an exit, right? Otherwise, you see on the chart what has happened. Correct? So if you time your purchases right and if you time your sale right, we sold here in September 19, then we sold in December 19, and then we sold in January 2020. If you pinpoint those selling areas correctly and if you exit at the right time, okay, that is what contributes to the return. If you just hang in there saying that no, I want to hold on to this stock forever, no, that doesn't work. You can't hold on to a stock forever. You are not Warren Buffett. Okay. So that's my analysis of this stock. Very, very simple. What trade management you did? Hardly. All you did was you bought during this week. That was the one good thing that you did. Another good thing that you did is you sold here, then you sold here, and then you sold here. So, three, four good decisions you made on a single stock, and you held on to the stock from August till December, August till January. So, roughly 4 to 5 months, generated a 4% return on your portfolio in 4 to 5 months from a single stock. That's that's decent professional trading. Okay, generating 4% return on a portfolio from a single stock, that's a huge return. Imagine getting 10 stocks like this in a year. Is it possible? Of course, it is possible, right? 10 stocks like this, that's a 40% return, correct? So you have done very well on this stock if you hang in there for that many months. So it pays to stay in a stock for a long period of time, tracking that 10-week simple moving average. And what indicators have we used here? Nothing. No Bollinger Bands, no stochastic, no MACD, no Ichimoku, no ADX, no Fibonacci or whatever, what not people use. Okay. Here we just use price, volume, moving average. That's it. And our understanding of the base and the bars, the color of the bar. That's it. And we just managed the trade with a simple tool called as the moving average. The 10-week simple moving average. I am not even using exponential moving average. Why to complicate things? Just keep it limited to simple moving average and you're done. Okay. So that's part number 48. Let's look at a couple of more examples so that we can end this series. We'll look at examples of bases and charts. Couple of more examples should do the work for you. By the way, if you watch the series till here, it's like 48 videos. By this time, your approach should become professional. After watching 48 videos, if you're still wondering what to do in the market, then you know you are not concentrating. So please watch this video series once more. It will help you and write down all the rules and criteria and all that. Write down trade execution criteria, write down stock selection criteria. Trade management is very simple. I have just shared with you one technique. There are millions of techniques, but I've just shared with you one simple technique, not to complicate things. William O'Neill's book will give you so many techniques which I never understood. So I just keep it simple. I just follow the moving average. Thank you so much.